All right, let's dive in. The global economy in 2025, it kind of feels like it's pulling in two different directions at once, right? We hear about growth, but we also see a ton of instability. So the big question is, what does any of this actually mean for your money? Today, we're going to connect those dots, from massive global debt all the way down to your personal savings. So what is the real story of the economy right now? On one hand, you see some positive signs, but on the other, there's just so much uncertainty. With policy changes and big shifts in global trade, it feels, well, contradictory. Is this just a moment of chaos we have to survive, or is there an opportunity hiding in plain sight? That's what we're going to try and figure out.
To figure out where we're headed, we first have to understand the massive forces that are pushing and pulling on everything. So we're going to start with the 30,000-foot view, a look at the entire world's balance sheet and this weird relationship between wealth, debt, and the actual economic growth we all depend on.
Okay, check this out. This is a pretty wild stat from the McKinsey Global Institute. For over 2 decades, for every single dollar we've invested in the real economy, building things, creating jobs, we've actually created $2 in debt. So what does that tell you? It means a huge chunk of our economic growth has been fueled by borrowing, and that creates this fundamental and maybe even unstable imbalance.
And all that borrowing helped create this monster number, $600 trillion in global wealth. But here's the kicker. That wealth has grown way, way faster than the actual economy. McKinsey calls this being powered by paper gains. Basically, it means the value of assets like real estate and stocks has just ballooned, mostly thanks to low interest rates and all that borrowing, not because we're proportionally more productive.
So where did all that wealth actually go? Well, that brings us to another huge imbalance. This latest McKinsey report shows that a full 20% of that $600 trillion is held by just the top 1%. Now, that's not just a statistic. A concentration of wealth like that really shapes everything. From how people spend their money to what politicians focus on, it just adds another layer of complexity to the whole picture. Okay, so what's the fix? Well, according to McKinsey, the only way to get out of this sustainably is to boost productivity. We basically have to innovate and grow our way back to a healthy balance sheet. But that is way easier said than done. It would need this massive coordinated effort where Europe invests more, China starts buying more stuff, and the US saves more. That's a really tall order, especially in today's political climate.
And as if that huge structural imbalance wasn't enough, you've got the day-to-day friction of global politics. International trade is where economics and politics crash into each other, and right now that whole landscape is just full of tension. And 2025 is a perfect example. You've got the ongoing tariff talks between the US and China. Then there are new discussions between the US and Brazil trying to cool things down. Meanwhile, trade negotiations between India and the US are hitting roadblocks. All of this political maneuvering has a very real-world effect. The actual flow of goods on ships across the ocean is slowing down, and that's a classic sign of a potential global slowdown.
And this chart shows you exactly what that looks like in the numbers. In late 2025, for instance, India ran a huge trade deficit, over $32 billion. That means they were importing way more than they were exporting. But then you flip over to Brazil, and they had a surplus. These imbalances really matter because they affect everything from currency values to jobs at home. It creates economic winners and losers.
Okay, so we've looked at the big picture on global debt and trade. But how do these huge forces actually impact a specific market? To find out, we're going to zoom in and use India as a kind of case study. With that recent trade deficit and those tricky negotiations, it's the perfect place to see how these global trends are creating real pressure on the ground. For anybody who watches the markets, this is a key signal. The Nifty 50, which is just a list of India's top 50 companies, is trading below its 50-day average price. Now, in simple terms, that's widely seen as a short-term sign of weakness. It's like the market's momentum is starting to fade. But that weakness, it goes deeper than just the biggest companies. If we look at a much wider group of 750 stocks, almost 60% of them are now trading below their 200-day average. Now that is a much longer-term health check, and it suggests that the majority of stocks in the broader market are now officially in what you'd call a bearish or a downward trend. So what's the takeaway from all that? Well, as the analysts at Prime Investor put it, the market tried to push higher. It failed, and then it fell through a key support level. In non-technical terms, that's just a clear confirmation of weakness, and it suggests prices could have further to fall. So caution is definitely the word of the day.
And all of this brings us to the most important question of all. When you're faced with a world that's out of balance and a market that's feeling the pressure, what are you supposed to do with your own money?
How do you even begin to navigate this kind of landscape?
It's the first question that pops into your head, isn't it? After hearing about global debt and trade wars and bearish market signals, that gut reaction for a lot of us is to feel a little bit of panic. But is that the right move?
Before we answer that, let's just get some perspective from history. This chart shows the annual returns for India's Nifty 50 going all the way back to 1996. Through all the crises and all the volatility, the market has finished the year in the green 22 times, compared to just 7 years in the red. That means it's had a positive outcome over 75% of the time. It's just a powerful reminder that in the long run, patience often gets rewarded.
So instead of panicking, financial experts pretty much all say the same thing. Focus on your strategy. And honestly, it's surprisingly straightforward. It just starts with defining your goals. Like, why are you even investing in the first place? From there, it's about being smart. Keep your costs low, because fees will eat up your returns. Don't put all your eggs in one basket. Diversify. And finally, just check in once in a while to make sure your plan is still on track.
And diversifying really just means understanding your options. You know, on the lower risk end of the scale, you have things like a public provident fund or guaranteed savings plans that offer more security. Then, for people who are comfortable with more risk for potentially higher rewards, you've got things like stock market funds or real estate. The absolute key is to always match the investment's risk level to your own personal goals and your timeline.
And that brings us full circle, leaving us with the final thought. We started by looking at this major imbalance in the world, where the best solution seems to be this massive, coordinated boost in productivity. But for us as individuals just trying to navigate the ups and downs all this creates, maybe the most important virtue is simply patience. Which one do you think will ultimately matter more for securing our financial future? Something to think about.